Hi everyone, this video is in response to a question posted on one of my videos. The question was, when I search ETF S&P 500, it is showing me plenty of options, and how would I figure out which ones to choose? That is actually a great question because when you search up S&P 500 ETF on investing platforms like Sharesies, you see multiple options because different providers offer similar funds. There are several things to look for, such as which stock market it is listed in. ASX means it is listed in the Australian stock market. NZX means it's in New Zealand. And NYSE means New York Stock Exchange. Some ETFs are hedged by their local currency, meaning they reduce the risk of currency fluctuation, but it also means you could miss out on the currency going in your favor. And hedge funds usually have a higher management fee. Also, I probably should point out that there are S&P 500 funds and short S&P 500 funds. Short means the fund seeks to make a profit from a market decline, meaning you are betting that the companies which the fund is made out of will decline in value. I recommend you copy the name of the fund and search it on Google, because on the provider's website, it will show more details about the fund, such as what companies make up the fund. So for example, when you invest in the Vanguard S&P 500 ETF, ticker symbol VOO, these are some of the companies you are essentially investing in. So when you buy into this fund, 7.24% of your investment will go into Apple, 6% goes into Nvidia, and so on. Different funds will have different weights. Another thing to watch out for is the expense ratio. Fund providers charge you fees to cover the operation costs. These are usually deducted from dividends and capital gains distributions. If you look at the Vanguard, which has an expense ratio of 0.03%, compare that to ProShares, which is a 0.91%, that is a huge difference, and over time, that's a lot of money. This next part wasn't part of the question, but let's quickly look at the pros and cons of investing in funds. The downfall of investing in funds is that, let's just say Tesla does really well this year, but if all other holdings in the fund decline in value, then you would not get much of a return from the fund. So even though one company does really well, if majority of the other holdings are not doing well, then your returns will not be that great. The pros of investing in funds is that from one transaction, you get exposed to all these top companies instead of you buying individually into these companies, which could cost you in transaction fees. Another pro of investing in ETF is that you minimize risk. Let's just say Apple gets into a really bad legal problem and it goes down in value. Well, if other companies in the fund is doing well, then it'll cushion the impact on you. And it is unlikely that these companies will do bad in the long run. By long run, I mean 5, 10 or 20 years. So hopefully this is a good starting point for when you're looking to invest in ETFs. See you in the next video.